Well, good morning, Bob.
Good morning, Bill.
It's a beautiful Monday morning here in Oxford and all along the East Coast, and we're talking today about housing prices and how it appears as though the sun has come out on housing prices and is shining.
Well, they've been going up now for quite a while. We just released our index numbers for June, and we saw on our national composite about a 0.6% increase, which is the 12th month in a row that it has gone up.
Now, did you say 1/6? A sixth of a tenth?
That's right.
Wow.
0.6%.
Wow. So not even a whole percent.
No.
But now if you read the popular press, you'd be led to believe that housing prices are going up at an annualized rate of 12–15% a year, maybe even more in some markets.
Yeah, it's really interesting. And we saw this during the bubble, that the repeat sales indexes, the Case-Shiller index, the CoreLogic index, those indexes are going up faster than our index, our hedonic index.
Let's stop there for our listeners out there, and let's step back and talk about the difference in a repeat sale and hedonic index, and then let's talk about how that's impacted by differences in data.
Yeah. Well, a repeat sales index takes a house that's sold in the current period and matches it to the prior sale of that same house.
So if it sold 5 years ago,
right,
we figure out the rate that equates what it sold for 5 years ago to what it sold for today.
Right. And you aggregate that across all the houses that sold in the current period, and that's how you get your index. The hedonic index is different in that it takes information about housing sales and looks at the various components of those houses and applies that across the whole housing stock. And then that's how you get your index to measure the change.
Instead of looking at one house and how that house sold, changed over time, and then aggregating that, we look at the individual attributes, right? And how that contributes to the value.
Right.
And the change in value.
And during the bubble time, back prior to 2006, when the rates were going up so fast, we felt that the reason that the repeat sales index was going up so much faster than our index was because of the subprime. That a lot of houses, typically lower priced houses, were turning over on a regular basis.
They were being bid up.
They were being bid up, and that was driving all of the price increase, because essentially if only those houses are selling, that's being assumed to be representative of the whole market.
Well, and what you've got in the repeat sales index is the data set only includes the sales, correct?
Only the houses that have sold, and only the houses that have sold for which there is a prior sale information available.
So two limiting criteria.
Right.
And what you're talking about is a data set that includes all of the houses that have been appraised, basically.
Right.
The sales and the refinancings.
Exactly. And the other thing that...
Even new construction.
Even new construction, which is not in a repeat sales index. So what's driving the difference today? Why are the houses in the repeat sales index or in the price index showing it to be much higher than what our index does? And I think one thing is that a lot of the repeat sales today are a sale from a prior foreclosure. So if it was previously a foreclosure sale, that was a depressed...
Artificially low, probably.
Right. And now it's sold at the market, and so the increase is much larger, and that's driving that index way up. And ours doesn't use foreclosed transactions. We exclude all foreclosed transactions, only arm's length transactions, so we're comparing consistently across time.
Which is the definition of market value. Market value assumes you've got arm's length transactions. Well, let's talk about the relative differences in sizes of the data set.
Well,
just give us some, because that's important.
It exactly is, and it varies obviously by MSA, but in a typical MSA with really, really good data, it's like the LA market or some of those, in any given year, typically fewer than 5% of all this housing stock actually sells, for which there is a prior sale.
So you're going to exclude 95% of the data.
Well, 95% of the homes are excluded from the analysis.
So you're going to exclude 95% of the home data. I mean, that's just
Yeah, I mean, that's true. And
from the housing stock.
right, and so what we try to do is incorporate all of that in there and reflect it, because just because low-price houses are selling like hotcakes, you know, they're really going up.
They may bias that data stream.
Yeah, and the big houses are not selling right now. Does that mean that all house prices are going up? No, some are going up, some are stable, and so to try and capture the whole market, you have to include everything. For example, there's an article in the San Francisco paper this weekend talking about the fact that when the housing market was crashing, there had been a large number of big condo developments that had been done, and there was no buyers for those, and so they converted those to rentals, right? And now they're converting those back to condos and successfully selling those. But from what I understand, the prices of those are not dramatically above what you would expect. You know, they're not super high prices, but they are selling. But all of those are excluded from the repeat sales index because there's no prior sale.
Well, so let's step back and talk about the practical implications of this. What we're seeing, number one, is we are seeing price appreciation across almost all markets, right? Number two, it's a slow price appreciation, which is, at least economic theory would tell us, financial theory would tell us, that's a good thing, all right? Because you get the big ups and the big downs, that's not good. The slow appreciation is a good thing. It provides stability. We will probably see home equity lending come back into the marketplace as we see values begin to increase.
Right. They've got a couple of things that got to happen. One, the house prices have to get significantly above the mortgages.
Right.
Okay. And now we've been.
Got to be in the money.
Right. Got to be in the money. So it's been what, 7 years now since the crash.
Well, people have adjusted down. They've either paid down their mortgage or they've said goodbye.
Right.
And the bank has written it down.
Right. So we've got, during that 7 years where there has been essentially no equity lending, people have been paying down their mortgages, okay, so they're building equity that way. And now as the values start coming back up, we're starting to see some equity there. And we've had a number of our clients talking to us recently about trying to reinvigorate their equity lending activities, and we expect to actually see that starting to happen more.
Because there's some equity to loan on.
Exactly.
And our index is beginning to show that that's coming back slowly.
Yeah.
And now the repeat sales index is not showing that.
Well, it's showing it's coming back much faster.
Correct.
Right. And I don't know, any index is simply a measure of something.
That's right.
Okay, so it's measuring something different than our index is measuring it.
But for lenders out there, the upshot is what we're seeing is we are seeing that equity is coming back into the marketplace, values are going up, there's stability that has appeared in the marketplace. Those are all good things.
Those are all good things. Some markets are coming back very strongly. Phoenix, Sacramento.
Well, they went down so low.
That's exactly right.
There's
something about that. It's easier to come back up from a really low point than it is from a high point.
It's like a rubber band, but the problem is, like a rubber band, it doesn't completely spring back.
Yeah, and so anyway, some markets are coming back pretty strongly. My hometown, Tucson, I saw that is no longer the foreclosure leader of the country. So foreclosures have dropped way off down there. So
is that your words of wisdom for the day? Tucson is no longer the foreclosure leader?
Yeah, exactly.
Oh, okay. All right. Well, this is FNC's Morning View. Dr. Dorsey is giving you his words of wisdom for the day. I'm Bill Rayburn with Bob Dorsey. You all have a fantastic week.